Welcome to Sir Lancelot's Real Estate Roundtable, your guide to mastering the realm of real estate in Central East Florida. I am Sir Lancelot Lenard, ready to uncover the secrets of seller strategies, home staging, mortgage mastery, and more. From Daytona Beach to Cocoa Beach, Lake County to St. Augustine, join me as we navigate the intricacies of real estate. As the leader of the Sir Lancelot Group at Florida Homes Realty and Mortgage, I'm here to arm you with knowledge and innovation, whether you're a seasoned homeowner or a first-time buyer, unveiling the kingdom of real estate, one roundtable at a time. What if the key to unlocking bigger profits in real estate wasn't in the deal itself, but in the numbers behind it? Today's guest believes that proactive financial strategy, not last minute tax scrambling, can transform how investors grow wealth. Welcome back to the Real Estate Roundtable. I'm your host, Lancelot Lenard, and joining me is Anne Gannon, CPA, founder of the Largo Group and host of the Franchise Accelerator Podcast. Anne is changing the way entrepreneurs and investors think about money by turning accounting from a backward looking chore into a forward focusing growth strategy. Whether you own a short-term rental, manage a portfolio, or dream of scaling into the next big thing, Anne is here to show you how the right financial playbook can maximize your bottom line and set you up for a long-term success. Anne, welcome to the podcast.
Yes, thank you so much for having me. I'm very excited to be here.
So, Ed, every hero has a starting point. What inspired you to launch the Largo Group and create such a unique approach to accounting?
Yeah, my dad was an entrepreneur. I grew up actually playing competitive golf. So between those two backgrounds, I feel like I had a unique approach to childhood and that I was traveling all over the country and watching my dad start his own business. His business actually it was not successful. So when I was in high school, things were really tough financially for my family. And yet I was out playing golf and meeting all of these really successful business owners. And what I realized is, how hard being a business owner is, and just how interesting it is to try to create something that hasn't existed before. And when I finished playing professional golf, I decided to go back for a master's in accounting and ended up at a public accounting firm in Boston. And what was interesting is most accountants come to that place from the accounting world. Like, you've studied numbers and you just know the rules. But my background, you knew there was so much more here than just the numbers. And what I didn't love about public accounting is just how transactional it is. You're just doing a tax return and making sure people are compliant, but yet you're speaking with all of these business owners who really don't understand as much about accounting as the accountants do. And yet there seems to be this dividing line. And pretty quickly, I was like, I don't know that the world of public accounting is for me, but I love accounting. And so my goal from the very beginning with the Largo Group was to find a different way to connect with business owners. How can we have more real discussions? How can we make sure that you, the business owner, understand what's going on? And how can we really focus on improvement? And I think that that was always our goal. When COVID hit, that became even more our goal, that it wasn't even just about giving a monthly P&L, but how do we actually stay engaged with you weekly to make sure as the world is changing, we're making sure that we're helping you change your business model so that you can survive. So ultimately, that's my goal. Is just numbers are part of it. That's the job, but really making sure that we are driving toward the path that you want to get to as the business owner.
You're definitely a visionary in this. And what was that turning point where you realized, was there a special transaction, or were you dealing with a client or something when you saw that regular traditional accounting wasn't serving business owners as well as it should?
So it really was that, not to date myself, but I started in the public accounting world in 2007. And
Okay.
2007 was great. My firm was doing well and everyone was really happy. And then all of a sudden 08 hit, and the returns that were coming, the numbers that were coming to us were bloodbaths. And no one seemed to notice. Wow, like last year they were profitable, and this year there's a six-figure negative, and it's okay, the return is done, or you're getting money back. And I'm like, well, the world is crashing. Like maybe we should talk to them to see, are they going to weather the storm? Do they know what to do? And the world of public accounting, especially at that time, I think even now, was just, we don't have time to have that conversation. It's March 10th. We can't. Or the thought was, because we were a bigger firm, they're not engaging us to ask our opinion. Like they're not engaging us to have, that's the consulting side. They're engaging us to do the return. So don't ask, because our ROI was to be as efficient as we can and get through the return as quickly as we could. So that's not your job to ask those questions. And to me, I'm like, that's not what I want to do. I don't mind doing the returns. I like doing tax returns, but I really want to get to know the business owner and have time to have those conversations. So I think that was the aha moment that probably wouldn't have happened if it wasn't that like the world was crashing around us and we're just sitting here doing tax returns. And I'm like, I don't know, that's the best use of our time. So
it's always interesting how you speak of tax returns. It's so exciting. God, it's one of those times of the year where I'm like, God, again, I have to sit down and do all my numbers and my bookkeeping. And I haven't done my bookkeeping for 12 months because
yes,
so I'm running my businesses, don't have time for the bookkeeping, but the numbers are really important. So
yes,
my most successful year, I did bookkeeping every month.
I
I'm not
know.
kidding you. I knew every month where every dollar went. And
I know.
then when it's not as good, you just neglect it because you try to focus on building or something like
Yeah.
that. And that's where a good accountant comes in and shows you the P&Ls. Like, hey, Lance, you're overspending on marketing.
Yeah.
You're only making this much. You should be only spending this much to make it a balanced sheet. And
Yeah.
I think that's really positive. I think, guys, everybody needs a good CPA, as for sure.
Yes, exactly.
So many investors only think about taxes once a year, like
I
myself.
know.
Why is that mindset holding them back?
I think, like you said, you don't realize that that you're speaking the language of accounting every day. Like I joke, in the book I wrote during COVID was called Shotmaker. And it really was about the idea of we're taking our next shot. But one of the things that we talk about in the book is that the idea of asset versus liability is in our day-to-day thought. Like you could apply it to your manager if you wanted to, or your cleaning crew, right? Are they an asset or are they a liability? Are they breaking things or are they driving me closer to my bottom line? So I think as business owners, I blame accountants for this a lot, that we make this complex thing that's so hard to understand. But if you really break down the rules of accounting, it's in everything that we do every day, because that balance sheet, as much as we avoid it, is really true, right? Do I have assets? Do I have things that are going to have future value? Or do I have a bunch of liabilities and I'm missing that future value? I need to work on things that are adding more value to my company. And so I think if we can break down the barriers and not make it this physics type approach, but really get it back to a simplified approach, then I think you see value add. Because I think a lot of times when we're avoiding it, it's because it's not adding value to you, right? Like it's not really something that's
You're like
giving
looking
you
at it
anything
as an
more.
expense instead of an
Yes.
asset. Oh, it's another
Yes.
expense on my sheet. I'm like, I'm paying $200 a month for a bookkeeper. Where, on the other hand, you would be doing how many hours of work of bookkeeping? I know because when I ran my books myself, and I just told you that, like, I think it was 2022, it took me, I think, about 2 to 4 hours a month to
Right.
run my books properly. If you spend $200 for someone, that's $50 an hour. I think your self-worth is higher than $50 an hour if you're a
Right.
CEO. So instead of getting into the nitty-gritty and going through the numbers yourself, here you go. Hand it off to someone to do it for you. I don't know how much you guys charge. I'm just saying a number. I think I found someone online that would do it for $200. That's why I pulled that number out.
Yeah.
I don't know how much bookkeeping costs really.
But I agree with you. I think that's where bookkeeping isn't the end, right? I think a
Oh,
lot of business owners, it's okay, the books are done. Well, but the real question is like, what are we going to do with those numbers? We should have a forecast for next month, or we should have a plan. How can I add $500 to my bottom line? Whatever it is, I think so many times, and again, that's where I think accounting gets it wrong, is that's not the end point. That just means we can now have the conversation of what we're going to do, because we first need to make sure the books are complete and everything's in there. But if we don't have that conversation, then it's just $200, right? Like you could have spent that at the end of the year and had all 12 months done at the same time. But if we're not going to learn from those numbers every month and come up with a plan to make it better, then it's just an expense.
plus, you could also see during those months of doing the bookkeeping is that you can see that where you're saving money and how much you're saving, let's say in tax benefits, et cetera. So now you're like, okay, if I'm saving that much, my tax is going to go down, which means I have a higher budget to work with a new investment or whatever else it is. And I think that's going to be,
Yes.
we'll talk, I think, I'm pretty sure you're going to bring that up down the line.
Yes. Exactly.
Can you share a story of a client who was struggling with their short-term rental and how weekly financial strategies changed everything for them?
So I think short-term rentals are no different than any business, right? That we have to really treat it as a business, understand the revenue side, understand the cost side. But to me, the biggest part of the strategy for short-term rentals is not losing sight of the long term. Because a lot of times everyone hears online about how much money they're going to make out of the short-term rental. It's six figures. There's all this inflated stuff out there. And it probably was true or is true depending on specific areas, but it's not true for everyone, right? You can be in a property that just isn't performing the way that you thought it would. And I think so many times when we look at it in a vacuum of they told me on YouTube I was going to make 10,000 a month and I'm not, I'm break even. This is a bad property. And I think without that monthly budget, without that, what we like to do is three approaches, right? The first one is just a 12-month budget because there could be seasonality in the property. Spring just might be bad for that area, but summer's great and winter's great. So we first have to set expectation for the whole year and break it out by month. So we know if we're having a bad month, is that part of the plan or is that not part of the plan? The second part is a 3-year plan for the property because the other piece that everybody misses in real estate as a whole, short term especially, is that your rents will go up, right? And it's not just because your property is going to be better performing next year, or you're going to be higher in the Airbnb or whatever it is. It's also just because of inflation. The best part of real estate is that you're hedging against inflation. So if milk goes up 10% next year, your rents are going to go up 10% next year. That's just life. And I think as investors, especially in short term, again, I blame the YouTube people that nobody talks about. It's not that you're going to do a better job with your property 3 years from now. That's just life, right? That's just inflation. So we have to factor that into our model because not all of your costs are also going to go up by the 10%, right? Some are fixed, your mortgage is fixed. So there is a point where that property will get more profitable just because that mortgage factor and inflation, and yet most of our expenses are fixed. So what we really want to do is make sure that we see beyond just the 12 months and we see into the longer term of this property so we can make sure that we aren't being short-sighted with where we are. So a lot of what I've tried to do, especially with people who are struggling in the property, is just make sure that they're looking longer term.
There's also a bunch of stuff that a lot of people don't take into consideration unless they're like professionally doing property purchasing, selling and flipping and etc. Is there's so many added benefits to owning a property. As an accountant, you know that there's appreciation, about 3% a year on average, I think. There is deductions and other tax benefits to owning a property. And if you're looking at a property, it's a good investment or a bad investment. They always say the 1% rule. So I was saying that there's other benefits. And if you have a good CPA, let's say I tell you I own this property, tell me what am I going to win on this property, et cetera, et cetera. Then you're going to say, hey, Lancelot, you own this property. We got a depreciation of X per year, which you're going to save in taxes. Then we got your write-offs for your insurance. You got your write-offs for your whatever, general maintenance, et cetera, et cetera. Then you got your benefit of a 3% growth, annual growth on appreciation of the property. Then you got your income from getting the rental part of it as well. So it's not just, hey, how much my rents are, how much my cost is. It's a way more complex thing. And government wants you to buy real estate. Everybody, that's the truth.
Yes.
They give you all these benefits so you can buy real estate. Opportunity zone, that's another one that not so long ago, about 6-7 years ago, started with the first Trump term, I think. I have an opportunity zone property, which means that at the 10th year, if you have a good CPA, they filed, it's called, what is it called? It's a trust kind of deal, opportunity trust or something like that. So they filed that paperwork with the IRS. After 10 years, you have no capital gains when you sell that property. Now you got a big bonus from the government. That's if you're looking at properties in the millions, that's a lot of money. Even in the hundreds of thousands, it's a big chunk of change that you're saving after 10 years, and you can exit without having to worry about a 1031 exchange.
Exactly.
So these are also benefits a CPA can help you with.
Yes. But I think it's also, and that's not to plug our services, but I do think it's having the time to have those conversations. Because again, if your expectation is that conversation is going to happen in April, it probably isn't. Like the CPA is so focused on the current year that we really have to, as much as everyone avoids taxes until the spring, it's probably the best time, even before the end of the year, to take a look at all the things that have changed, all the things that you want to do. Have the conversation about thinking of selling the property before we sell the property, before we put it on the market, because I think as investors, like you said, it's a very nuanced with the way the depreciation went down. Did we take bonus depreciation? Did we not? What's the cost basis? What's the amount the property has appreciated? Because there's lots of different ways to plan for that appreciation if you sell it, but we really have to be aware of what those things are before we're under the gun when the property's already on the market.
That's a really big thing. And I think also, I'm not sure, pretty sure, yeah, you guys probably offer this, but I have to be proactive in finding out these things like opportunity zone properties and this, that, and the other thing. But if you have a good CPA that already knows the insides and outs, they come to you with, here, these are my 10 commandments.
Recommendations,
sort of,
yes.
my recommendations. Look, you're buying a property. You could buy a property here and here. The benefits of certain different areas can long-term tax gain, et cetera, et cetera. There's so many options for that. And then like, if I would send you a property, I'm planning on buying this property. This is what you don't do as an investor. Don't send your property to your CPA before you buy it. You just go and buy the property. But if you have a good CPA on your team and you say, hey, look, I'm planning on buying this property. It looks like we're going to go under contract for it. What are your thoughts?
Yes.
You know? And then you send that to your CPA, and the CPA goes, oh, this is a pretty good property. It's an opportunity zone. It has this benefit, that benefit. It looks like you're getting it for a good price, deductions, et cetera, which is awesome.
Yeah.
So that's my thought.
Yes. No, I agree. I think it all just comes down to really understanding your whole tax picture, because also as investors, every year may be different depending what else has happened in your business or in your life. I look at it all as starting point of your effective tax rate. So if you're a business owner and you did a bunch of expansion work and you have a bunch of depreciation coming this year, you may organically offset some of these gains or sell no different than as a market. People look at it as a portfolio. That's really what your tax picture is like. You have a lot of moving parts. So we really have to know, what does this year look like? Because it could vary tremendously year over year. And what someone said 3 years ago may not be true today because of different things that are happening in other places of your business. So I think really being aware of the timing, what every year looks like, and ultimately what's your effective tax rate in that current year can help with making some of these other decisions.
For sure. So what are the most common mistakes short-term rental owners make, and what simple changes make the biggest difference?
Yeah, I definitely think it's the short-sighted, right? I've seen throwing the baby out with the bathwater too many times of, I just went out of this property, it's not working for me, and not really seeing the long-term that it's setting up. I think what I really try to bring to the table for short-term investors is that long-term approach, because short-term, relatively new, like the trendy thing. Everyone wants an STR, and it's true. It does tremendous things from a tax benefit side, but ultimately, it's no different than other rentals in the sense that buy and hold strategy is the one that's going to get to the best result. That so many times I look at my retired clients from just a tax book perspective, and my happiest retired clients have a bunch of rental properties. Obviously, not a lot of short term because they're a little older. They have rental properties they've owned for 40 years, or it's a property they got from their parents and now they own it. And the biggest win is that those properties have very little debt, if any, and they just collect this check every month. And so really what they've done with these portfolio of rental properties is almost created their own retirement plan, because
Right.
whatever happens in the market, whatever happens outside, they have their 8 to 10 grand a month that they collect or more, or whatever it is. And it's going to go up every year because of that thought of inflation. So unlike the people in the market who had pensions that had set amounts it was going to pay out every year and now it's uncertain, they're not uncertain. They know they're going to raise their rent. They know they have a bunch of equity that's just sitting there. So if, the world came to an end, they have so many levers they could pull. and still be fine. And I think we're, as short-term investors, again, we're all looking at like the 3 to 5 year, but really it's that 15 to 20 year, when if it's a good property and it's something that you want to own for the long term, then the goal is paying it off, getting that equity appreciation, and ultimately knowing that it's going to generate more money from you 10 years from now than it generates today.
Correct, correct. So for listeners who own one property, how can they use your methods to set themselves up to scale to 3, 5, or 10 properties successfully?
So I think a lot of, like I said, in our method, it's the 3 period approach, right? So you have your 12-month budget. We ultimately have the personal tax. So getting to know what your personal tax looks like today, what anything that's changing, anything that you're thinking of doing. And then that third one being our 3 to 5 year plan. Because a lot of times in that 3 to 5 year plan, again, even if the property is losing a little bit of money, let's say it's losing $500 a month, not ideal. We obviously didn't enter this to lose money, but part of that cash out is that mortgage. So as we're paying more towards principal, the idea is this property, because it's not just paying down the principal, but in most years, this is a good assumption, it's going to go up a little bit. Maybe it's, break even. The property value will go up 2% even. So if you play that out over a 5 year period, as we're paying more of the mortgage down, the property is appreciating. And so together, now we know in 3 to 5 years, we should have enough equity to leverage this property if we wanted to into a second property, right? That's really the strategy, is stacking on one to the other and really paying attention to that equity appreciation, so we can do things like a cash out refi, things like that, and now have multiple properties. And that looks scary at first, until once you play with the model, which again, I think is that proactive side of what could we afford, right? So obviously we're going to cash out refi property one. That's going to add some sort of payment. What do we need property two to generate to obviously pay that down? And collectively, really that goal is, what is my portfolio value in 5 years under that method? It's not necessarily going to get the most cash in my pocket today, but if 5 years from now I own 5 properties that are 500,000 each, look at my net worth compared to only one today. So I think
Correct.
that's where the long-term strategy can be very exciting.
I'm for sure the net worth, building the net worth up, and then being able to borrow more money, because as your net worth grows, banks like to lend you more money so
They
you can
like you
buy
more.
bigger and better
Yes.
properties. That's the
Yes.
whole point.
And that's where I go back to the retired example. If you're a retired couple that has 5 properties, they have a ton of leverage, right? Like if something happened or they needed to move to Mexico, like they have a ton of power sitting in these properties because they have equity. And I think that's really what the goal is, even now, is just building towards that.
Yeah. So how do lessons from hospitality, like guest experience and operations, apply directly to real estate investors?
I definitely think the idea of going back to things I find really empowering is that 12-month budget, because as the STR owner, you are relatively in control of your revenue, right? So no different than if you were owning a restaurant or a retail, whatever it is. These are your customers, so we want to make sure they have good experiences. Obviously, a lot of people say it, the guest rating, all of that's important. But I think also knowing that you are in charge of some of the marketing, that we don't have to just use Airbnb, that we can be creative. I've had a lot of people, once you see, what's empowering about it is seeing that break even point. So if I know I have to bring in $5,000 a month to make this property break even, that now helps me make it something that's tangible. I'm not just sitting there frustrated because I see the cash account going down, or frustrated because I have repairs. I think it's really empowering you to make the best decision. So if I know I have to get to $5,000 and it's a slow month and there's no tourists or whatever it is, then maybe I can be creative. Maybe you hear a lot of times people talking about the traveling nurses, or being creative outside of Airbnb for 2 week periods, whatever it is. But I think just putting the power back in your hands to know, okay, here's the target. I have to get $5,000. How am I going to do it? And then that 12-month budget, maybe there's months that we just know that we can't. But I also know in the summer I'm going to make $10,000 a month. So it's going to work out over a 12-month period. So when I know I'm in an off month, it's okay. It's not panic time. It's just part of the plan. We're going to minimize our low months, maximize the high months to get to the best result over the course of the year.
That sounds really the way to do it, of course. I've interviewed a lot of guys, two or three, maybe even four people already, that are in the short-term rental business. And I think they need to talk to you too to even maximize what they're doing right now because they're doing really good. Don't get me wrong;
Yeah.
they're amazing.
Well, but even if you're doing well, I just think that budgeting is so important. And I think a lot of times in the short term, people forget that we're running this like a business. So, just like
Correct.
anything, we have to have a forecast, we have to have a target.
So, what's one hidden profit lever that most owners overlook?
I would say paying attention. So everybody right now, the trend is using these AI generated or for the pricing, right? So whatever price labs, whatever it is. And I think remembering that everybody else is using that too. So I find that there's such a difference between the owners who are actively involved in the pricing versus the ones that are just like, oh, I have it set up here and that's what it tells me to price. And because I think especially in the low months, people are making last minute decisions. So if your pricing isn't is reactive versus proactive, you can miss some of these last minute bookings. So I definitely find when I look at my SDR clients, there's a big difference in revenue generated by the ones who are really putting the time in to pay attention and be available. And hey, I'm going to drop it quickly because I don't have this weekend filled versus the ones that are like, oh, price has sold me $300 and nobody takes it at 300, but maybe they would have taken it at 285. So I think really digging in and putting in the extra time on the revenue side at the beginning can really change your outcome for the month.
So, what's your thoughts on those programs that do automatic adjustments? Because
I
I
mean, I
bet you
think
you've heard
they're
of
good.
those.
I'm not saying they're not. I just think sometimes you still need to be paying attention because they can get it wrong, or there could be people watching your property. And so just being a real person who's just making that last minute decision and also knowing your break even point. Because if I know I have to make 5 grand, I don't want it sitting vacant for a weekend. Being more engaged than just letting the program decide. Because ultimately, we all want our revenue, our nightly revenue to go up. But we also know that we need dollars in the pocket are better than not. So I think that's where there's a reason we get the business write off for the SDR, that it does take time and it's not something that just gets set and forgotten. So I do think putting in that time usually does generate a much better result.
See, is SDR one of your like main focuses, or do you guys like big apartment complexes, all that
So we
stuff?
do all types of real estate planning. I think what I find in the SDR world is I fight for the entrepreneur, right? I want to see my entrepreneurial clients, whether it's SDR or business owners, like I want to see them win. And I feel like just like I see on the entrepreneur side with the business owners, there's just a lot of misinformation. And I find that that's where I like to step in and be like, let's get this right. Let's get it right for you. Not everybody's the same, the social media people and the influencers. That's great. What they did is awesome, but let's build the plan that is awesome for you, not necessarily just following the
Yeah,
box.
trend.
Yes.
The next TikTok.
Yes, exactly. That's great, but that's not what tax strategy is, and that's not going to lead to the best result.
Where do you see short-term rentals and financial strategy heading in the next 5 to 10 years?
I don't think short-term rentals are going away. I think a lot of times, even from a consumer standpoint, people love Airbnb. You look at even in like the college towns, parents love to get an Airbnb because they get more time with their college kids than just a hotel. I think you obviously the hotel side, they don't love Airbnb. It's a competition to them. So obviously they're building things that are more similar to Airbnb to meet that demand. I think especially on East Coast. So especially on the East Coast, like there are always going to be places where those hotels aren't, right? And there is a unique experience for a lot of places to be in an Airbnb. And I think what you find in that world is the people that understand that customer. You look at like outside of New York City, right? A lot of New Yorkers love to go to Airbnb communities because they can be in a bigger space that has 5 bedrooms and has land. And so that's the experience you're looking for. They're not going to get that at a Marriott or a Hilton, right? They're just not. So I think being aware that that demand is always going to be there, but there's always going to be competition. And just like business owners, you're dealing with increased competition, increased people who know what they're looking for. I think as STR, just like anything else, it's always going to evolve. You just have to make sure that property is something that works for you long term, because STRs are great, but even if it didn't, you still want to make sure it's property you like. It's not just some random property that we're buying. for no
Definitely,
one.
you're not Starbucks to do the market research front, unless you're really good at that. And then if you're really good at that, you probably could build a whole empire, but most people are not. But usually it's a good thumbs up. Rule of thumb is like, hey, if Starbucks coming to town, then we should probably start doing Airbnb in this
Yes,
town.
paying attention
Pay
because there's
attention to detail.
Airbnb for communities that are growing and things like that. Yes,
Yeah, yeah,
100%.
yeah. If you could give one piece of advice to an investor looking to build long-term wealth starting today, what would it be?
So the biggest thing that the STRs bring to the table is the tax treatment because they're treated as a business. So you're able to generate a much bigger tax savings immediately if you're a higher income earner. Now, obviously, it works the best if you have a high W-2 or high other income that you're trying to offset. But I think that's really where that idea of STR building long-term wealth, that's really what it is doing, is just drastically speeding up your tax benefit so that you can leverage it into other investments. But I think as a strategy, there's other ways to do it. So that's where I think it's really developing like, what is your long term plan? What are you currently paying in tax? What's your current effective tax rate? And how can we ultimately build a plan to larger net worth in the next 5 to 10 years in areas where you would like to focus already?
Got you, got you. And how can real estate investors maximize tax returns without leaving money on the table?
So the biggest one is understanding the rules, right? That active versus passive treatment. Are you really a passive investor? Are you an active investor? Are you running this as a business? I think your legal structure matters. How is it set up? Do you have a portfolio of properties that you're managing? Would it make sense to have a management company? There's very complex legal structure and tax structure that can benefit you tremendously by at least looking into, because ultimately the goal is, especially if you have multiple properties, how can we structure this to make sure that you're getting the benefit for those properties, obviously following the IRS guidelines, but making sure that you understand those guidelines and we're making the best choice. Because I think so many times the real estate portion of a tax return was just, it's just over there. You'll get the benefit when you sell. Like, it's okay. A lot of passive loss carry forwards and all of that. And I think the more complex thought now is, could we build this out as a business so you're getting some of those deductions and benefits now to offset the dollars that you're spending now?
Yeah, that makes a lot of sense. Any inspiring short-term rental success stories that our listeners can learn from?
Yeah, I think the biggest success story I see are the W-2 earners who are building their own portfolio to eventually replace their income. And I've seen, that a few times now, probably more than a few times now, but it's really exciting to see people who are like, oh, this was the first property and now I have 8 to 10, and it is generating that six-figure dollar amount that I wanted it to. And now having those real discussions of, what would it look like if my spouse retired next year, but one spouse is going to stay working for now, and eventually transitioning into both. So I think the dream is possible. I would say that goal of 10 to 12, and now I'm really in control of my own destiny, even if you want to stay working or not, but I am really building that cash flow and long-term wealth that you talked about from Property One. Those are the success stories I love because there's still so much nuance there, right? Like, we still should have a budget for each property. We should still have a plan. We should still know, what is this property going to generate in 5 years? What's my equity in each property? So there's so much there that I really enjoy working with our investor clients on, because it's not just, oh, I'm done. It's still work, but it's exciting work because we're really building our own portfolio.
That's awesome. And this has been an incredible conversation.
Yes.
Yeah, I think it was awesome. You've shown us the numbers aren't just about compliance, they're the roadmap to long term success for anyone who wants to dig deeper. Guys listening, you can connect with Anne and the Largo Group on their website, Facebook, Instagram at the Largo Group, and LinkedIn. Don't forget to check out their Franchise Accelerator podcast for even more powerful insights. If you found value in today's episode, please hit the subscribe button, share it with a fellow investor, and leave us a review. It helps us grow the Real Estate Roundtable community. Until next time, keep investing smart, building strong, and we'll see you on the next episode. Have a fun day, everybody. Thank you for joining us on Sir Lancelot's Real Estate Roundtable, where we've unveiled the mysteries of real estate together. Remember, in this kingdom of possibilities, every dream home is just a discussion away. I can help your real estate dreams come true. Just call me at 786-449-7518. Until our next roundtable, may your ventures be prosperous and your homes be filled with love and joy. Farewell, fellow knights of real estate.